When applying for a surety bond, the underwriters will take into consideration several financial facts, including quality of CPA year-end financial report, work-in-progress schedules, account receivable agings, retainage versus non-retainage, level of interest-bearing debt, retaining profits in the company. Since the start of the recession, most sureties will only accept reviewed or audited financial statements. In the past, surety companies accepted a compiled financial statement. In today's environment, the compiled financial statement will limit your bonding capacity to roughly $500,000 or $600,000.
The surety will be looking at how much disclosure your financial statement has in terms of schedules and notes. Typical schedules in a financial statement are statement of cash flow, statement of retained earnings or reconciliation of retained earnings. It'll list out your work in progress, that's jobs in progress, and also jobs that have been completed during the current fiscal year. As far as notes, it'll tell the history of the company and what type of work they generally do. They will look at related companies and whether there's interaction between the two companies. They're going to look at how you prepare your financial statement on what method of accounting versus how you pay your taxes on what method of accounting. Look at your level of debt, how much is current and how much is long-term. These are typical schedules that you would see, but there could be many other schedules included in a financial statement, such as subsequent events, how much debt is due from stockholders or due to stockholders, things of that nature. The more information you can provide, the more detailed your financial statement, the better your chances are for maximizing your surety credit. The different types of financial reporting, there are four. That's percentage of completion, accrual, completed contract, and cash basis. From a surety standpoint, the percentage of completion gives you the most accurate snapshot of your financial condition at that point in time. For tax purposes, you can use any of the other methods of accounting. Usually it's cash method for taxes, but you can do both.
Work-in-progress schedules have become one of the most important focuses of the underwriter. It has not always been that case, but given today's current environment and today's trends, a large emphasis is put on the work-in-progress report. The work-in-progress report allows the underwriter to determine trends from period to period, profit fade or profit increase as projects progress, as well as how much profit remains to be recognized on jobs in progress. More detailed reports are encouraged and should include revised per project profit projection, percent complete, revenue recognized in prior fiscal years. This report allows both the contractor as well as the underwriter to determine how much additional revenue will be needed to achieve break-even and eventually profits in the company. Surety companies need to be able to distinguish first what's retainage and what's not retainage. So if you can break out in your aged receivable report your retainage versus your non-retainage is a plus. What happens when you have over 90s that are not retainage, the surety company takes that number and drops it below the line, therefore impacting your working capital and your equity position.
Problem receivables should be written off as soon as you know that they are problems. It should be written off in the current fiscal year. If you didn't write these receivables off, you would be paying taxes on them. Therefore, obviously, you do not want to carry these receivables on your financial statement if they are disputed or you consider them a problem to collect. The fourth thing underwriters look at to maximize your surety credit is how much interest-bearing debt you're carrying on your financial statement. Underwriters understand you need to borrow under your working capital line of credit, such as when a job is starting or you're having a problem collecting a receivable and you need to meet payroll. However, you should always be striving to reduce your reliance on the working capital line of credit so that you can demonstrate you can fund your own cash flow internally. One way to reduce your reliability on your working capital line would be to turn over your receivables in a quicker fashion, reducing retainage as quickly as possible, and perhaps delaying your payments to vendors and subcontractors. This way you won't have to borrow under your line of credit as often. This will also reduce your interest expense and increase your profit accordingly. The fifth thing underwriters look at is retaining your profits in the company. The reason you want to do that is to build your financial statement, to make it stronger. The stronger your balance sheet, the more surety credit you can expect to get in return. If you're showing a loss on your financial statement, that can detract from your ability to get surety credit. If you're showing a loss and then paying a dividend to stockholders under the Chapter S tax election, then you're really reducing your chances of getting surety credit.
Unfortunately, we see in cases where business owners, sure, they've worked hard and they want to reap some rewards, but have an understanding of what that is. What are the distributions? What are your intentions at the end of the year relative to the distributions? Or should the company have a loss and the owners take out a bonus or increase their salaries per se? Unless that's already been discussed, that could definitely decrease the amount of surety support. To recap, the surety company's preferences: reviewed or audited financial statements prepared by a construction CPA, bank line of credit without outstanding balance, being paid down frequently, cash is king, receivables collected in a timely fashion, certainly within 90 days unless noted as retainage, profitability, retention of profits in the company, ability to produce meaningful, internally prepared interim reports, detailed work in progress reports provided quarterly. Keeping these underwriting focuses in mind when making ongoing business decisions will lead to maximizing your surety capacity.